In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels and Stu. It's that time again. It seems like we were just doing this. I say that every time.
I think we do this probably once a week, don't we, Bill?
It seems like it comes around once a week. But this is our Coach's Corner, and it's time for us to share some of our coaching tips. And we were just talking about this during the sound check. One of the places that we get a lot of our information is from our Q&As. We hear people asking questions. What about this strategy? What about this? And they focus on the good side, but they never talk about the risk or what.
Which is what people do. That's what people. Oh, how much can I win? How much can I make?
How much can I win?
Without the what's the chance? What's the probability? How much can I lose? What if it goes wrong?
Yep.
None of that ever comes up.
Right. Stu and I say you got to finish the thought. You got to finish the conversation. There's always two sides. There's a good side and a bad side. If it were all good, there would be no money.
There would be probably be no market, dude.
And there would be no market because exactly, you find nobody to take the other side. There has to be something in it for the other person. That's a very basic tenet of finance, and yet these people completely miss it. So ready for today's, I've kind of given you a little clue where this is going, but here's our topic for today.
All right, let's do it.
Here we go. Drum roll, please. Here's our Chalk Talk question for everyone. The stock is 100. There is an $80 put trading for 50 cents. Question is, did you find a trading gem?
So let's see. What's the name of the stock? How much time is left?
There's only a few days left. It's 20% out of the money.
Rate? Is there a dividend? Blah, blah, blah.
Right. Did I find they go, well, that's a decent.
Am I buying it? Am I selling it? What?
Yep. So this is what we're talking about mostly on the sell side, that people would say, boy, if I sell that, that's some decent premium. And of course, we can always redefine decent by multiplying it by 5 or 10 or 20. We can make it any number you want. So what people look at is they say, this is 20% out of the money. There's no way the stock could fall from 100 to 80 in the next X number of days. Of course, that's a myth, but that's what they think. So this looks like, what's the word they use, Stu?
I think it's called free money.
You knew who read my mind. Yeah, this is free money.
Or how about this one?
This is gas
how
money.
Often do you hear this, Bill? Well, let's see. If I do get, in the off chance I do get assigned.
Oh, yeah.
I want to buy the stock down there anyway.
I want to buy the stock down there anyway. Right.
Without the benefit of the new information that caused the stock to go down.
To be trading at 60 now. Right.
Could that be important?
Yeah.
Maybe. Possibly.
Absolutely. And we have seen every single one of these. So what we want to do today is to dive a little deeper into our argument why this is a dangerous thought. We're going to show you two basic ideas behind it. We've covered them in previous classes, but they're kind of very fitting for this one. So let's start with our topic, which I think you kind of know where this is going.
We
You didn't
go ahead. Go ahead.
you didn't find an edge, you found volatility.
Let's make our disclaimer. We seem to have to do that every
Yeah,
time,
yeah, that's
right?
right.
We are not saying good, bad, perfect, nonsense. We're not saying any of that.
We're just saying what it is.
We're just saying what it is. We're just talking about the math part of it. We're going to talk about what it is without an opinion about whether it's
Yeah,
a
that's up. That's
gem
up.
or not a gem or good or you should do it or whether it's free money or none of that has nothing to do with any of this.
That's
It's
right.
just what it is. You
That's right.
you take with you take from this what you choose to
Right.
and do
One
whatever you want with it.
one of the things that Stu and I want to do is to say that we just want to focus on the math and the mechanics. We're not here to say, well, I think Nvidia is going up or I think earnings are going to be good,
No,
because that's not where the game is played.
no, no.
You could certainly have an opinion, but you're not playing the game unless you're talking about price. So what we want to focus on are things that are facts about markets, finance, economics, and things like that. So let's take a look at our topic here. You didn't find an edge, you found volatility. So what this is already hinting at, when you see these things that look like they're trading gems because they're so far out of the money and paying a relatively big premium, that is pure and simple, not a gem. It's a definition of volatility. And if you're playing a volatile stock, the probability that it actually hits there is much higher than you think.
And here's another thought, everyone. This is super important. This this concept that we're starting to talk about here, this applies to both sides of the curve.
Yep.
It's not just puts.
Nope. Calls are puts, puts are calls.
It's the oh, look at the premium I can get on these covered calls on this call that's so far out of the money. It's like
Right.
printing money. I'll pay for my Lexus this weekend.
Right.
See that it's the same discussion.
Same argument. Same
Yeah.
argument. So let's, but we are going to focus on the naked puts for this, even though, like you said, it's the same argument, just a different side of the curve. But we've been hearing this lately, and people asking about it in Q&A and traders. So let's talk about what we like to say are naked put illusions. So traders like to hunt for out-of-the-money puts that pay a decent premium. Now, right off the bat, we've already hit a stumbling block. How do you define decent? Is it decent because it's
I don't
relative to
know.
the strike, relative to the stock, relative to what you think is a good number? And if it's not a good number, can't we just multiply it out until it becomes a good number?
I love that. 21 cents. Is that a good number, Bill? I'm gonna
No,
sell this put for
but
21
but you
cents.
could multiply it by 20, and now sure, we'll talk
Now
exactly.
you can buy dinner, right? But 21 cents by itself kind of stinks, but it's the same number.
Or do it 2,000 times. Now we're talking about a car. Do it 20,000 times. You can always multiply it out.
And not and they and that's not the issue, people.
It's
That is
not the
not
issue.
the issue.
Right. Now, if it's out of the money by a certain percent, well, but a lot of traders have, maybe it's out of the money by 20% or by 25%, whatever, fill in the blank there. But it's out of the money by some certain percent, and then they claim victory that they have discovered gold. Hey, everyone, look at this. I have found this put that's 20% out of the money with a decent premium. And then everybody goes, oh, this is a great idea. Let's jump on it. We're going to talk about that. So if a put is 20% out of the money and pays 50 cents, then they chalk it up to easy money. We've heard people say this is gas money, dinner money. I call it printing money. This is free money. These are all gross misperceptions. I know you've seen your share of tragedies. I did too on an active trader team. Um, I have seen a couple that I can recall vividly of people going negative equity to $600,000. Now think about that. Hey, Stu, I know we've been doing business for a long time, but by Friday, I need a check for 600,000, and that's to get your account to zero. Well, what happened? Well, remember those 10,000 naked puts that you sold? The stock is trading down 40%. That's how that happens. And these traders never talk about that. So we want to ask, is this really a good find? Now, if you don't understand the math and the mechanics, sure, it looks like there's a low probability,
50 cents is decent. Let's do it 10 times. We can put 500 bucks in our pocket. Why not do it? We're going to show you why you have to think twice. So we have our friend, the bell curve here. So where does this come from? Stock prices move, at least the what are called the log prices, but they move according to a bell curve. So if the stock is currently right here in the center, let's say at 100, there's only so far it can go up, relatively speaking, in a certain time, and only so far it can go down. These probabilities get lower as we go away. So for a $100 stock, it's far more likely to go to 101 or to 99 than to 105 or 95. That's all this is saying. It's giving us the probabilities. So here's one of the magical things about bell curves. No matter what the shape, that they all share something in common. And that's super, super powerful. I could make this thing super low and flat. I can make it very tall and skinny, but this blue area here will contain 68% of the data, 68% of your observations. Now the blue, that's what's called a 1 standard deviation move. The blue plus gray is 2 standard deviations, and that is about 95% of the area.
In total.
In total. And then if we come out here to the tails, we're talking almost 100%.
Incrementally 13 and a half and 2.2 to be exact on the ends.
Yeah. So do these go to zero? No, there's a fourth and a fifth and a sixth standard deviation, but the probabilities are just not worth talking about. On this side, there's a -4, -5, and -6. They get incredibly small, but they are there. So this is the first thing that we have to understand is about what is the likelihood of getting hit. Not just, hey, it's 20% out of the money. That doesn't tell me anything. That's an absolute difference. We need to know, relatively speaking, how far that is. So before we get into the details, quick reminder, marketrebellion.com/get started for more topics just like this. I was just in there the other day, so we've got a nice little library of things, little articles and videos and things in there.
As we should.
Yeah.
Please take advantage of it, everyone.
It's all free. So let's talk about a good starting point. How are options priced? So in my example, this 20% out of the money put is priced at 50 cents. Why is that a decent premium? We have to say, well, relative to what? See, people never do it. They just go, that's a lot of money. Relative to what? So let's look at a pricing model. And we've got a stock of 100, strike of 100, roughly a year to expiration, volatility 20. I'm going to give it no interest rates. Now, one thing that is interesting is this volatility number, what traders call volatility, is the standard deviation. That's why we need to know it. This is telling us the center of the curve. Center of the curve is lined up right there at 100. Right? So picture your bell curve like this, sitting right there at 100. But how wide is it? This tells us the width. It's a 20% standard deviation. Okay, that's what it's basically telling us. And if we put these factors in, we hit calculate, it tells us that the call is worth $7.91. Now notice the put is too, like Stu said, just a different side of the curve. But for right now, I'm just going to price the call because these slides were very hard to create, but you can see it's the same story whether we're looking at the left half or the right half. So here's where this number is coming from. All right, some people think, where'd they get that number? Here's where it comes from. Here's our bell curve. There is our stock at 100, what we put in the pricing model. At 20% volatility in dollar terms, 20% of 100 is 20 bucks. So 120 would be one standard deviation up. 2 standard deviations would be 40. So there's our center. Now, if this is our call option, the only way we can make money is over here on the right. So what are all of these on the left immediately? Those are all zeros, right? That's worthless, which is why we said an option concentrates risk. All of these probabilities get just like rolling up this left half all the way to that red line. Everything goes to zero at that red line. And that's part of where the leverage is coming from. Now, let's take a look at, let's divide this blue area in half. So Stu, if this number is 100 and this is 120, where's halfway? Right there. 110. So if the stock is 110, what's the $100 call worth at expiration? 10. So you can see this is a very rough, crude model. Obviously, the probability is much higher here. The blue curve is much higher, much, much lower here. We're just going to say a very rough rule of thumb that this area is worth 10 with a 34% chance. Remember, the blue is 68. So the right half of the blue right here is 34. So the bell curve is saying if you can earn $10 34% of the time, that option's worth at least $340 to be fairly valued. Now let's look here in the gray. If the stock is here, it's between 120 and 140, which would be a number of 130.
30.
If we have the 100 call, it's worth 30. But what's the probability in here? Right? It's roughly 13.5%. Right? We just take the 95% blue plus gray, subtract out the 68, and then divide by 2. So it's about a 13.5% chance that you could win 30. So one thing we see with the call options, as that stock goes up, we can win more and more, but the probability is going down and down. So now we know the option's got to be worth at least the sum of those two. So let's just do a very simple example. What is that? That's 745. What did the previous model tell us? 791. So already an extremely rough measurement. We've kind of zeroed in a little bit of roughly what that option is worth. Now let's do it, go some more. This is really what the math is doing behind the black shoals. I'm trying to show it visually. Let's divide this up again. Remember, we only did the... So if this is 100 and this is 110, what's that number?
105.
That right there is 110. So now that becomes what? Just this left half right here is going to be 5 times 0.19, which is about 95 cents. All right, we divide this blue area in half. All right, so what is this? That's going to be price of 15 times about 15% to 25. We divide this in half. We look at $25 times 0.09. We divide this area in half, and we keep doing this. We keep chopping these areas down and saying, what's the payoff? What's the probability? So now with just those, I'm sorry, we got one more right here. That's a $45 payoff, but with about a 2% chance. And now if we add up all of these red numbers, we're up to 775. We're even closer to 791. And if we did it again and divided each of these in half and did it again and kept going and going, that number would converge to 791 and no more. That's where it's coming from. This is absolutely a probability game. It is not, oh, that looks like a decent premium. It's paid according to what it's worth. That's the thing that people miss. Okay, so remember, we've got all these zeros out here. All of the activity is over here.
Or collected for what it's worth.
Or collected for the
Right?
risk.
It
Exactly.
goes, I'm going to keep drawing this, guys. It goes both ways.
Both ways, you'd say, but
The number is the number. And look, you know, Bill's doing a terrific job of moving the distribution out and showing you where the numbers are coming from.
Right.
It just keeps getting lower, that probability, as you move further out.
Yeah, that's all that's
Now,
happening.
does it make it better, or does that make it a gem if you're a seller that it's not going to come to fruition? It's got less chance, so less probability. The market is pricing that
The market is pricing.
probability.
We're going to talk about that in a little bit, but that's exactly right. If you are an option seller, calls or puts, don't look at it as free money. In fact, you don't realize that money until expiration or until it's
I
closed.
believe they call it an obligation, don't they, Bill?
What it is it is a payment for accepting an obligation. That is very different from saying it's free money. Right off the bat, that is a gross misperception when people go, oh, that's decent premium. I call it printing money. It's not. You are completely misunderstanding the point. And that's when it becomes dangerous. So now let's say we have a stock at 100, volatility of 20%. One standard deviation move we said was 20% or 20 bucks. So again, we have 100 here. What happens? One standard deviation down is 80. It's just the $20 off of the 100. Two standard deviations down in dollar terms would be 60. Right? Just another 20 off of this. So we're going to look at the left half this time for the puts. What's the difference from here to here?
Looks like 40 to me, buddy.
40 bucks. Okay. Now, Watch this. Let's change it to a $200 stock, keep everything else the same. One standard deviation is 40 bucks. There's 200, current stock price. There's 160, $40 down. There's 120, another $40 down. What's the difference there? 80.
$8.
Wow, look, you are 80 points out of the money.
Wow.
It's exactly
That's free money.
Did that picture change?
No.
No, it's exactly the same thing. We could keep going. I could make this so far out of the money. And all you're doing is you're just putting, it's like taking a pencil and erasing these numbers and putting new numbers up and saying that the probabilities have changed. They have.
Or you could do it, like these are just plug-in numbers, everyone. That's all these models are.
all
They're
they are.
just plug-in numbers. Change the volatility.
We're going to do that.
Keep it 100, change the volatility, and you get the same picture. Dude,
We're gonna
it
do that.
doesn't change.
Yep, exactly. In fact, speaking of that, let's go back to the $100 stock. We'll change
Oh, there you
to
go.
40% this time. What happens now? 100 times 40. Hey, look at that. Isn't that the same number we just had?
Unbelievable. Unbelievable.
So we have 100. We go down to 60. There's 20. What's the difference there? It's still 80 bucks. The bell curve didn't change. All you're doing, this is why it's such a tricky illusion, is you're just erasing these numbers and then saying, well, for this stock, it's good. This one's bad, and this one's decent. And it's a complete optical illusion. It's the same curve. It's exactly the same curve, and people yet say, well, no, this one's good and this one's not. So we can make these anything that we want. I mean, subject to going to zero on this end, but on the call side, you can make them anything that you want. Now, here's where things get especially interesting. Let's make it a $500 stock with 50% volatility. Have we ever seen anything as high as 50% vol? No, never.
Oh, no.
We just saw some on car. What was car recently? 300,
600 in the front
or
week,
600 on some of them.
400 in the middle.
Crazy. You look in some of these biotechs, anything with the name therapeutics.
And that's the extreme. I mean, there's plenty of stocks running around right now with 80, 90, 100 implied volatility.
Lots of them.
These energy stocks.
Oh, lots of them.
They're just big numbers, big numbers.
Big numbers. So what happens is that the bell curve gets a little shorter and a little wider. And you might say, well, wait, your picture didn't change. That's just called scale. See, that's the illusion. It's the same bell. We already said that. It's the same bell curve. Now, a $500 stock at 50% is $40. But now here's what happens. If we do, I'm sorry, that should have been, but at any rate, I'm going to go into a log scale now, which is really what the Black-Scholes model uses. So instead of saying that should have been 250, instead of subtracting off 250, I'm going to make it 303. I'm going to explain why in a minute. And then 2 standard deviations down, it's going to be 184. Why are we not subtracting off 250 and then 250? Again, I'm sorry, that should have been 250 right there. So based on the previous ones, using it in dollars, that would be 250 and that would be 0. Well, what happens is that as a stock falls, that percentage changes. The amount of what I've done here is this is roughly a 39% change from here to here, and it's a 39% change from here to here. So we're keeping the percentage changes the same. What we did before, which is what traders do, are called the dollar changes. And right there is already a big misstep. It's good, it's okay for concepts, for teaching, but the way that the model works is this. And this becomes a little bit trickier to come up with the calculations. But what we're doing is we're keeping the percentage change the same from here to here and from here to here. The dollar changes are not the same, but the percentages are. Now, what's the difference here? We are 316 points out of the money. There's no way it's going to hit there. It's exactly the same probabilities that we saw in the other examples. It's the same mark.
Scale. It's just scale.
It's just a scale. But yet you can see where people look at this and go, man, that's got to fall like 200 points. There's no way it's going to do that. We've heard people say there's no way it's going to do that by Friday.
Yeah.
Well, the model would like to disagree with you because we have a $500 stock at 50% vol, and this number is very much in play. And that becomes the illusion right there, is that everybody thinks that somehow this ratio, looking at it in dollars, becomes special. And it's not. It's exactly the thing that I find interesting. It's exactly the same as the others we did. It's on the same spot. right there, same probabilities. So now let's do this. What if we look at a $400 put? Where does that land? Roughly, let's call that roughly 300 and 500 right there. So this $400 put is how far out of the money?
Hundo.
20%. Right?
105, yeah. 20%.
So now what do you think about, well, it's 20% out of the money. You're right in the thick of the storm.
But
And yet
I need to pay my car
right.
payment.
And hey, this is 20% out of the money and it's a very decent premium. Well, but look at where you're standing.
And hold on. And if I do this like at every earnings season and a whole
Right.
bunch
Every
of
3 months,
high
it's a
volatility
gift.
stocks, man, I can raise, 100 grand at the end of the year. I could generate 100 grand at the end of the year.
And you
Let me
could,
do that. Let me
but
step in and do that.
right, but the probability of that happening. See, that's just looking at basic math. If I do this 10 times each quarter times, yeah, that's basic math. You have to say, but what's the likelihood? That's like saying if I buy a lottery ticket each week, I've got a better chance of winning. Yeah, technically true, but it's still probably not going to happen. So here's a very good example where if you think you can stand just slightly to the left or slightly to the right, but just basically right here at the center of the curve, but you're always going to be on the winning side. Stu and I have a very special name for that strategy. We do not call it selling naked puts. We call it a matter of time. You just haven't been spinning the wheel long enough. It will come back to bite you with 100% certainty.
So
in
here's
an amount of
here's the
time.
trap, everyone. I mean, there's a few traps here. One,
Lots of them.
you will win more than you will lose. That's the math,
80% of the
right?
time, that's 100% true. Right.
You will do that. And a lot of people get sucked into this, well, what's my batting average?
Yeah.
Well, you can have an 80 or 90% batting average. You can have a 100% batting average. You can still come out behind the 8 ball.
Because if it's priced in there, it's not
It's
an
the
edge.
price has to do with it, right? So it's not the 80% win or 90, it's not that.
No.
It's the well, the 10 times or the one time that I get banged, what's it going to cost me?
What's it going to cost me?
And as risk people, that's the part that we have to focus on.
Yeah. And for
Right?
anybody
We sell a put for $5. We know there's $500 in it. 10
Right.
times is 5 grand. All that is known.
Yeah.
And the market is doing the work. The market is pricing it for you. And you look at it and say, hey, that's a good, let me take a chance. So you're betting on direction, number one, on the earnings. And which well, we all know it can go with, hey, it's like, I don't even know if it's a 50-50 shot, right? I mean, it's like, hey, great numbers and the stock gets hammered. So, that's an unknown. That's a piece of the puzzle that you have to think about. And the other piece is that those 2 and 3 and 4 standard deviations, while they may be rare, they are there.
They are there.
And they are there. And if you are not getting a handle on quantifying the amount of money that's going to cost you when, not if, when that happens,
right,
then you are not living up to your responsibility as risk manager, as fiduciary to your own account.
Right.
That makes you negligent. That makes you irresponsible. And if you think you're winning, you're getting lucky, and it will only be a matter of time.
Yep. And perfect example is down here in Florida. There were many insurance companies for 10 years laughing all the way to the bank. And in fact, insurance is priced like a casino in the insurer's favor. And they are laughing all the way to the bank. And then what happens?
Big storm
one time
comes.
And they're bankrupt. So yeah, you can have 10, 15, 20 years of accumulated profits, and then it's all gone. Now, here's where a lot of traders make another illusion. Well, I'll just select which hurricanes I'm going to insure.
Yeah, that's not going to work.
Good luck with that. You might skip the ones that came close and went right up the coast and were nothing, but still collected that nice big fat premium. And the one that you choose happens to be that one that's devastating. So now you have no cushion to even offset that. It becomes a very big illusion. But now let's talk about problem number 2. I said there were 2 main cases we were going to argue here. This is the first one. Second is this thing called an expected value triangle. And I think we've talked about this before, but in finance, it's kind of our little golden triangle here. You as a trader can choose your win rate. You are free to, I want to win, I want to find a strategy that wins 80% of the time. You're free to do that. You can also say, I want a strategy that's going to give me an average gain of 50 cents. You are free to do that. Just look on the board, we can find those. You could also define it as the average loss. But here is the kicker. You do not get to pick all of them. You pick one and the market prices the others. So this is the big one that people miss. So you can choose the win rate, the average gain, you can choose the average loss, but the market forces the EV to 0. So for instance, I don't know why that plus sign's sitting there. We have an 80% chance of picking up a buck. This is what traders look at. Oh, look, I've got a high win rate. That's a decent premium. And as we said before, you've got to finish the conversation. If there's an 80% chance to win, what do we know is true? 20% chance to lose. And the market says, we get to pick this. And the market says, we get to pick this. Why? Because if we take 80% of a dollar, 80 cents, 20% of -4 minus 80, we add them up. What happens? 0. Now you might say, well, why does it have to be forced to 0? Because the person you are selling this wonderful trading gem to is not going to do it unless there is a commensurate award for them. And it has to be in balance. So you can figure this out. Here's your odds ratio right here. 80 to 20 is how much bigger? 4 times bigger. So now we know that the risk you're taking must be 4 times bigger than the reward. Why? Because the probabilities are in your favor. The risk has to be out of your favor. And that's what makes it balanced. So here's an interesting way to look at it. Instead of saying, hey, everybody, I found something that wins a decent premium 80% of the time, you could say, hey, everybody, I found something where my risk is 4 times bigger than what I'm going to collect. Change it, word it that way, just to keep you grounded. Because
much better way to look at it.
That's what's happening.
Keeps you grounded. That's a great way to say that. Keeps you grounded, right?
And like Stu said, sure, 8 out of 10 times you're going to collect this. But 2 out of 10, you're going to lose this. And on average, not counting the commissions, you're going to be 0. That's assuming the market's priced these correctly. Again, that's the long-term average. You get one micron.
Which it does a really good job of.
It does a very good job of, but every once in a while, a micron sneaks in there. And you go, oh, I know the earnings are going to be good. Let me sell this put 20 times, and you get crushed. Now, let's try another one. Let's say that there is a 90% chance of winning $1. You can find some. Or you could say, I want to win $1. Then the market prices this probability. You could also choose this, but then the market chooses this. See, that's the triangle. You can only choose one of them. Now, you might say, I want a 90% chance to win $1, but you can't do it because they come together as a pair. The reason for this $1 is because of the 90 cents. So again, that's why you only get to choose one. So Stu, what's our ratio here? How much bigger is 90 over 10?
Kind of looks like 9.
Looks like 9, which means that our reward, or our risk must be what? 9 times bigger than that premium, which is 9. 90% of $1 is 0.9. 10% of 9 is minus 0.9. That should be minus 9. And that brings us to 0. So instead of saying, hey, everyone, I found something where I can get a decent premium or $1, 90% of the time, don't continue on and say, hey, thanks, Dave. That's an awesome suggestion. I'm on it. Hit the brakes, hit the thick yellow light and say, how can we rephrase it? I found an opportunity where my risk, where I could risk losing 9, 10% of the time. 10% is low, but it's not unexpected, right? If you had to draw 10 numbers out of a hat, you shouldn't be shocked that you draw the bad number. It's a lower probability, but it's not insignificant. Those are going to happen. And as Murphy's Law happened, what's going to happen on the very first time you try this little trading gem, that's going to be the time that it hits. Right? Now you just did this 20 times, times 9. And now you're underwater. So again, Stu and I are not saying good, bad, indifferent. We're saying here is the market math, and here are the mechanics of the market. And now it's up to you, but at least you're making an informed decision. So
yeah, that's it. That's it.
That's all we want you to do.
Know what you're in for. That's it. Just know what the chances are, know what the probabilities are. Right. Understand that it is a gamble and that things do happen.
Yep.
and that look, I mean, plenty of people make a lot of money doing this kind of stuff.
Sure they do.
But you just have to know what you're up against.
Yep.
And on the call side, oh, I sold these calls and it blew through, and oh, so what? I made money anyway. That's just a cop out, right? That means you don't really understand this
Right.
distribution. That's what this is. This is a chat about probabilities of a distribution, and
Right.
that is what an options market is.
Right.
That
So
that's what you're seeing on the matrix.
So what we want you to think of is don't stop your conversation here. I found a decent premium. Okay, well, what's the probability? Or, hey, I found a high probability. Okay, what's the reward? Don't stop there. Look at what's this side. That's why Stu and I say finish the conversation. You got to complete the expected
You have
value.
to. You
So
just have to.
quick little story. Stu, I think I mentioned this, but I worked at Schwab on an active trader team, and back in '87, I know you were on the floor when this happened, so you know
I
the
was.
chaos down there.
Brokers weren't picking up the
There was
phone.
one trader that left Schwab in such a deep hole, one trader,
Hmm.
that they almost went bankrupt. They had to fly overnight to a bank that they had a relationship with to get an emergency loan just to have the minimum equity to open their doors. Think about that.
Wow.
One trader.
Unbelievable.
And now there is multi-billion dollar company and almost completely wiped out of existence by
Yeah.
one trader. So
Yeah.
don't think it can't happen to
Oh,
you,
I
please.
believe it. I believe it. I was
Yeah.
with First Up in that same time period,
Same. Yeah.
and we, there was a lot of chatter about because people were blowing out left and right in
Oh,
that
left and right.
crash.
Yeah. It's a shootout.
And there was a lot of chatter that First Op couldn't meet their obligations, and Spear Leeds was going to have to come in, and Peter Kellogg, and they're like, oh, it was a mess, and people were getting carried out on stretchers. It
A
happens.
big scene about that in The Big Short
The
about
Big
that. All
Short,
of the
yeah,
yep.
yeah.
So watch that if you're not familiar with it. But we just don't want to see it happen to you. So come back to our chalk talk. Stock is $180 put, 20% of the money for some price, let's say 50 cents. I call it a decent premium. Stu calls it printing money. Somebody else calls it free money. Let's answer the question. Let's hit the brakes. Did you really find a trading gem? So, what do you think the answer is here? How would you answer it, Stu?
Well, yes, no,
No, or it was my original one, but I also gave it a little bit of a hedge, not necessarily
yeah,
because without doing further digging, but the point is just based on this, there's
no,
no way to tell.
no.
There's
I would say from the trading side, and this is decades behind me.
yeah,
I would say I like the sale. However,
yeah,
and then I start filling in the blanks. However,
right.
what
That's the
if the stock
conversation you
goes
got
to
to have.
60?
Right.
Then what? And
Then
how
what?
can I hedge my opinion here?
Yep.
See, that's what I would do. And
But that
maybe I need to
requires
go down to like the 65 put, pick that up for a nickel or a dime or something like that. At least I know.
not
See,
a
then
bad
I know
compromise.
what I'm in for,
Right.
and I'm not betting on some random event. Well, I'm betting on the random event, but I'm putting my
Changing the payoffs.
I'm putting my chances of disaster in a box that I can identify and that I can either say
And can
I'm
live with.
in or I'm out.
That's
And,
right.
and that's it. That's
And
where the conversation really ends.
and
But you have to
and
have that conversation.
right. And that's what we want to have from everybody here. So when next time you feel like you're in a chat room or in our Q&A and saying, "Hey, I found this. What do you think this is a decent premium or this is a high probability?" Stu and I are going to say, "Finish the thought." And what we mean is take the other side.
Take the other side. Take the other side of
Now
the
let's
trade.
talk about it. And that's a very good step to keep you out of trouble. And a lot of
But
what this game is not so much about how you win, but how you avoid the trouble. So
it's
we hope that
it's
gives you
how
some
you
good
lose.
stuff
You
to
got to
think
learn how.
about.
That was one of my first lessons, Bill. I told you that. Remember that guy said to me,
Hmm.
Dude, you stink. You're never going to make it." I said, "How come?" He says, "Because you have to learn how to lose.
That's right.
You
So
have,
we
you have
hope
to
that
learn
gives you
how to
some
lose."
things to think about, and that's
And
our
and
goal
here,
here.
lastly, one final thought here. I'm first of all, I'm so passionate about this idea because people just don't see the reality of it until it's too late, and then they're calling up saying, "Oh, well, the market did this." No, the market didn't do anything to you. You did it to yourself because you didn't understand the product. If you just for an example, let's just say the call you're looking at that put, and you're saying, wow, that's a great sale. All right. Well, if you really believe that's a great sale, then you also have to believe that the other side is a really crappy buy. I mean, you got to do both, right? You can't have it, well, one's great and the other one's great, right? If one's great, the other one stinks. And if that's the case, then if the buy side is if the sell side is cool and the sell side and the buy side is stinky, doesn't that same argument take place on the other
right.
side
You
of the
can't
distribution
pick one
curve
and reject the other. Right.
on the call side?
Right.
It's the same distribution. Yeah,
Same
there's
thing.
tweaks and there's skews and there's all
Right.
that. I get that part, and the market prices that, but
Right.
it's still there. It doesn't mean it went away because you're on one side or the other side. So the next
Exactly.
time you're kind of thinking about, well, this is a great sale, think twice. Just think about what we did. Next time you're thinking about on the call side, hey, this is a great buy. Think about it. Why is it really a great buy? Why is it a great buy? Why is somebody selling it to you? What exists that doesn't exist somewhere else? Is it time? Is time saving me? Well, it's just a question that you have to ask yourself. Are you paying for the time? Are you not paying for the time? If I go in, the conversation goes so many places. I'm on a rant here. Move. You're in a little shorter dated option and you feel like you have to roll it out because the theta is going to start kicking your butt. Really? Well, the option is so much cheaper than it was on the other one. Then what are you really worried about? It just goes on and on and on. So
Exactly.
again, just not good, not bad, not do it, not don't do it. Understand the mechanics behind it. Understand that the distribution does exist. Understand that you are capturing a point on that. It's called the strike price on that distribution, and that the market assigns a price to the probability of the distribution. And that's it.
Exactly. Okay. So with that, we hope that you picked up some good tips to think about, and we'll see you next week on Coach's Corner. We'll see you then.